In financial markets over the past week, a renewed surge in crude oil prices has created ripple effects across major global stock indexes, exerting particular pressure on travel-dependent industries like cruise operators. This movement is closely tied to growing geopolitical tensions between the United States and Iran, prompting investor concern over energy supply risks and the broader economic impact of potential conflict. Crude oil benchmarks, notably Brent and U.S. West Texas Intermediate (WTI), have climbed to their highest levels in roughly 6 months. This rally comes as negotiations between the U.S. and Iran regarding Tehran's nuclear program stall, and military posturing in the Persian Gulf increases the perceived risk of supply disruptions through crucial oil export routes like the Strait of Hormuz. While energy stocks have benefited from these dynamics, sectors with heavy fuel costs, such as cruise lines, are under pressure, highlighting how macroeconomic and geopolitical forces can reshape investor sentiment and sector performance. Oil price surge and geopolitical backdrop rally to multi-month highs. Recent trading data shows global crude oil prices climbing significantly, with Brent crude rising to over $70 per barrel, marking levels not seen in several months. U.S. WTI crude prices tracked similar gains. Analysts have attributed this surge primarily to market fears that rising U.S.-Iran tensions could disrupt oil supply from the energy-rich Middle East, which is responsible for a substantial share of global crude oil output. Role of U.S.-Iran relations. Market participants are focused on diplomatic talks between the United States and Iran, which have yielded limited progress. As negotiations appear to stall, traders are pricing in a greater geopolitical risk premium, meaning they are willing to pay more for oil now to hedge against possible future supply constraints. The risk is heightened by speculation about potential U.S. military responses to Iranian actions or nuclear proliferation concerns. Reports indicate that the United States has increased its military presence in the region, and Iranian leaders have made defiant statements regarding their nuclear program. These developments have led investors to factor in the possibility, however uncertain, of supply disruptions or conflict, pushing crude prices higher. Strait of Hormuz, a key choke point. Many analysts point to the Strait of Hormuz as a central vulnerability. Nearly 20 million barrels per day of oil pass through this narrow waterway, about a fifth of global oil consumption. Any disruption here due to geopolitical escalation could sharply reduce global supply. The mere threat of such disruptions has been enough to lift prices and inject volatility into markets worldwide. Market impact. Beyond oil broad index movements. The oil price rally has come at a time of other market pressures, including mixed corporate earnings data and broader economic uncertainties such as interest rates and inflation. Major U.S. stock indexes, including the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite, have shown modest declines amid this risk-off sentiment as investors shift away from high-risk assets and towards safe havens or sectors that benefit from higher energy prices. Sector rotation, energy versus travel. In this environment, the energy sector has been one of the few bright spots. Stocks of major oil producers rallied strongly alongside crude prices, as investors saw these companies benefiting from increased pricing power and higher future earnings potential in a tight supply scenario. However, other industries feature a very different picture, especially sectors where fuel costs represent a significant portion of operating expenses. Cruise stocks under pressure. Why cruise stocks are vulnerable. Cruise operators such as Carnival, Royal Caribbean, and Norwegian Cruise Line are particularly sensitive to changes in oil prices because fuel costs can be one of the largest expenses after labor. When crude oil prices rise, so do bunker fuel costs, marine diesel, which directly eat into profit margins. Unlike land transport, where fuel efficiency can be improved over time, cruise ships have limited short-term flexibility to reduce fuel consumption without cutting capacity or slowing sailings. Higher fuel expenses can force cruise companies to either raise ticket prices, potentially depressing demand, or absorb the cost, squeezing already thin margins. Stock performance reflects cost risk. Recent market data revealed that shares of cruise operators fell as oil prices spiked. For example, Carnival Corporation, Norwegian Cruise Line, NCLH, Royal Caribbean Cruises. These companies' stocks reportedly slid as traders rotated out of sectors facing cost headwinds. Some online travel agencies and travel-related stocks also experienced declines, reflecting broader expectations that travel spending might slow if costs rise or consumers become uncertain about future economic conditions. This outcome contrasts sharply with energy stocks, which have seen increased interest from investors capitalizing on rising oil prices. Industry expectations and consumer behavior. Cruise line executives and analysts have cautioned that higher fuel costs could eventually lead to higher ticket prices, reduced profit margins, or fewer special offers, all of which could weigh on demand, particularly if global economic growth slows or consumer confidence weakens. For passengers, the ultimate cost of cruising could rise in areas like fuel surcharges or ticket price adjustments, potentially influencing booking patterns and travel plans. Wider economic and investor reactions. Risk sentiment and inflation concerns. Beyond sector-specific implications, the oil rally has implications for global inflation expectations. Higher energy costs often feed into broader consumer prices, impacting transportation, manufacturing, and consumer goods. Central banks, including the U.S. Federal Reserve, may take such inflationary pressures into account when setting interest rates, which could further influence equity markets and corporate investment decisions. Safe havens and currency movements. Heightened geopolitical tensions tend to push investors toward traditional safe haven assets like gold or the U.S. dollar. In recent trading sessions, the dollar strengthened, while some commodity prices, including precious metals, saw increased interest as investors seek protection against uncertainty or potential inflation. Conclusion: uncertain times for markets. The emerging picture in financial markets, shaped by rising crude oil prices and geopolitical risk, illustrates how external factors such as international diplomacy, potential conflict, and energy supply vulnerabilities can reshape financial performance across sectors. While energy companies benefit and may continue to attract investment, more fuel-intensive industries like cruise lines face rising cost pressures that could dampen profitability and investor enthusiasm. For cruise stocks, the near-term outlook may hinge on both oil price trends and consumer demand resilience. Should oil prices continue to rise or geopolitical tensions escalate further, cruise operators may face deeper cost challenges, potentially translating to continued weakness in their stock prices relative to broader market indexes.